I still remember March 23rd, 2020. The market was down 34%. My phone kept buzzing with news alerts every few minutes. Everyone around me was selling everything. My neighbor called that morning and said he was pulling out completely. He couldn't watch the numbers fall anymore. I didn't sell a single share. Instead, I bought more. That decision, made in one of the scariest moments of my investing life, changed my financial future. Today, I'll show you exactly how dollar cost averaging turns a market crash into your most powerful wealth building tool. Real mechanics, real numbers. You'll get the real data from 2008 and 2020, plus a complete step-by-step system you can set up tonight in about 30 minutes. Most people think a falling market means losing money, but that thinking is completely backwards, and it's costing the average investor hundreds of thousands over a lifetime. Here's what's actually happening when prices drop. You're not losing money. You're getting a discount on the same assets you were buying last month at full price. The Dalbar Institute research from 2023 showed the average investor earned 3.9% annually over 20 years. The S&P 500 returned 10.6. That 6.7% annual gap isn't bad luck. It's one repeated behavior: selling when prices drop and buying when they rise. The exact opposite of wealth building. Dollar cost averaging is the mechanical system that forces you to do the right thing, even when every single instinct is screaming at you to stop investing. Here's the core mechanic. You invest a fixed dollar amount on a fixed date every month, regardless of what the market is doing. Always the same amount, always the same day. When prices are high, your fixed amount buys fewer shares. When prices fall, that same amount buys more shares. You automatically accumulate more when markets are cheapest. This sounds almost too simple. And it is simple. The hard part isn't understanding it. The hard part is actually doing it when the market drops 20%. Let me show you what this looks like through 4 real people with incomes close to yours and very different outcomes from the same market conditions. First is Olivia. She's 31, earns $4,300 a month, and works in marketing in Chicago. She started investing $250 monthly in January 2020. When the crash hit in March, Olivia panicked and paused contributions for 5 months. She resumed in August after the market had already recovered 60% of its losses. She missed the 5 cheapest months of the decade. Her account today holds $31,000 less than it would if she had simply kept going automatically. Now meet Felix. He's 36, earns $4,800, and teaches in Colorado. Felix automated $300 monthly in 2019 and never touched the settings again. March 2020 arrived. His automatic contributions kept going. He bought shares at the lowest prices seen since 2016 without making a single conscious decision. By December 2020, his portfolio had grown 41% from its March low. Felix didn't do anything clever. He just didn't interfere. Automation made the right call for him. Then there's Maya. She's 29, earns $4,100, and works in healthcare in Georgia. Maya understood dollar cost averaging, but made one critical mistake with it. When the market dropped in March 2020, she moved her entire emergency fund into the market to take advantage of the dip. 3 weeks later, she needed money for car repairs. She sold at a loss. The lesson is permanent. Dollar cost averaging works with your investment money only, never with your safety net. These are 2 completely separate systems. Finally, Raymond. He's 42, earns $5,200, and works in finance in New York. He had been investing for 15 years, but always tried to time his contributions. He paused when uncertain, increased when confident. Over 15 years, his return was 5.1% annually. A colleague automating the identical amount monthly earned 8.3. Raymond's emotional adjustments cost him over $90,000 across 15 years. Not from dramatic errors, from small repeated emotional interference with an otherwise solid system. The pattern across all 4 is identical. The system wins. The emotion loses, without exception. Every bear market, every cycle, every decade, this has been tested in history. Now let's talk about the psychological reason this is so difficult. It's called recency bias. The brain's tendency to assume whatever is happening now will continue indefinitely into the future. Research in the Journal of Behavioral Finance from 2021 showed that during downturns, investors overwhelmingly believe the crash will last for years. It almost never does. The average bear market lasts 11 months. The average bull market following it lasts nearly 6 years. But your brain cannot access historical data when it's feeling present pain. Dollar cost averaging mechanically overrides recency bias. When contributions are automated, your brain is removed from the decision. The system acts on historical truth, not current fear. Here's the math that made this real for me. You invest $300 monthly for 12 months during a crash. Share price starts at $50. You buy 6 shares in month 1. Month 4, price drops to 30. You buy 10 shares. Month 8, price drops to 25. You buy 12 shares. Your average cost is now $34 per share across all purchases. Month 12, price recovers to 45. You hold shares that cost you 34 on average. That is a 32% gain during a year, when the market ended nearly flat. This is not theory. This is the mechanical reality of what consistent investing during volatility produces, every time it has been measured across market history. Lower cost, higher return. Here is the exact 4-step system I use and recommend for someone earning $4,500 a month. Follow all 4, or the system breaks down. Step 1. Choose a fixed monthly amount that feels boring, not ambitious. For most people at this income level, that means somewhere between $200 and $400 per month. Step 2. Automate it completely today. Log into Fidelity, Vanguard, or Schwab and set up an automatic transfer on a fixed date. Remove your hands from the decision entirely. This is non-negotiable. Step 3. Pick 1 or 2 index funds and stop there. VTI for total U.S. market, VXUS for international exposure. No individual stocks, no sector bets, no adjustments based on headlines. Step 4. Write this rule and put it somewhere visible. I do not change contributions based on market conditions. Ever. Read it when you feel the urge to pause, cut, or stop entirely. Now the 30-year math, because this is where the numbers become genuinely life-altering for someone earning $4,500 a month today. $300 monthly at 7% after inflation. After 20 years, $157,000. After 30 years, $304,000. Add the crash buying effect. During bear markets, your fixed amount buys more shares at lower prices. Historical analysis adds roughly 1% annually to effective return for consistent investors. At 1 extra percent annually, 300 monthly over 30 years becomes 341,000 instead of 304, 37,000 extra from not stopping. The 2020 data is concrete. An investor contributing $200 monthly across all 12 months put in $2,400 total. Their year-end portfolio, $3,100. That is 29% growth on money invested through the most volatile year in recent memory. Because they bought heavily at March, April, and May lows without pausing contributions. The investor who paused March through July contributed the same annual total but bought only at recovered prices. December portfolio, $2,640, 9% less from one pause. 2008 is even more powerful. The investor who kept buying monthly through the entire crash held through 2012 and was fully recovered and in profit by mid-2012. The investor who stopped in late 2008 and restarted in 2010 when things felt safer did not break even until 2014. 2 full years lost from one emotional decision. I remember February 2021, 11 months after that terrifying morning. I opened my portfolio and saw it was up 38% from the March low. My neighbor had just re-entered. He called again, this time asking how I stayed calm enough to keep buying through the crash. My answer was the same then as it is now. I didn't stay calm. I removed calm from the equation. I automated the decision so emotions could never reach it. That is the entire system. Not intelligence, not market knowledge, just automation held precisely when holding feels completely wrong. If this gave you a concrete system, Hit like. It tells the algorithm to show this to people watching their portfolios right now and considering the worst possible decision they could make. Next on the channel, the exact 5-segment portfolio structure for someone earning $4,500 a month, built to survive any crash and profit from every recovery that follows. One question for the comments. Are you currently investing on a fixed automatic schedule? Or do you adjust based on how the market feels that month? Write below. I read every response. Here is something most people never calculate: the true cost of waiting for the right moment to start investing. Every month of waiting has a permanent mathematical consequence. If you start investing $300 monthly at age 30, you reach retirement with roughly $800,000, assuming 7% annual return over 35 years. Start at 35 with the same amount in return. You arrive with $560,000. 5 years costs $240,000. Not 5 years of growth, a permanent gap. The crash doesn't create this gap. Waiting for the crash to end creates it. Every month out of the market during a recovery is a month of compounding you permanently forfeit and cannot recover. Now, I want to address the most common objection I hear. Emily, what if I start and the market drops immediately after? This fear stops more people from building wealth than almost anything else. Let's run that scenario with real numbers. You invest $300 in January. The market immediately drops 20% in February and stays down for 12 months. What actually happens? For 12 months, your contributions buy shares at a 20% discount. When the market recovers, and it always has, you hold more shares at a lower average cost than anyone who waited. A University of Michigan study from 2019 tested every 12-month S&P entry point across 60 years. Consistent investors beat market timers in 87% of all cases tested. The 13% where timing won required near impossible precision, exact peak entry, exact bottom exit. No real investor achieves this consistently. In practice, they do the exact opposite. This is why the question is never, is now a good time to invest? The question is always, how much longer am I willing to wait while my future self pays the price? Let me also address what dollar cost averaging is not, because misunderstanding this costs people real money and real opportunities they cannot get back later. DCA is not a strategy for trading in and out of the market. It is not a tool for capturing bottoms. It is not something you activate during crashes and deactivate during recoveries. It is a permanent, automatic, boring system that runs in the background of your financial life, regardless of headlines, regardless of elections, regardless of interest rate decisions by the Fed. The moment you start treating it as something to turn on and off based on conditions, you have converted a wealth-building system into an emotional guessing game. And the guessing game loses. One final piece that most dollar cost averaging explanations skip entirely. What you invest in matters almost as much as the consistency of your investing. The wrong vehicle breaks the system. Individual stocks introduce company-specific risk that index funds eliminate. One company can go to zero. The total U.S. market has never gone to zero and has recovered from every crash in its history. Sector funds concentrate exposure where you need it spread. During a crash, sectors fall together, eliminating the protection that cross-asset diversification provides when you need it most. Simple, broad, low-cost index funds make dollar-cost averaging work as designed. VTI, VOO, VXUS. Expense ratios under 0.1%. No stock picking, no guessing, just the entire market. Combine automatic monthly contributions with broad index funds and multi-decade patience, and you have the same system used by the most successful long-term investors in recorded financial history. Not the flashiest system, not the one that gets talked about at dinner parties, the one that actually works, quietly, automatically, and precisely when the world feels most uncertain.